Museum of American Finance. And first and foremost, I'd like to acknowledge the two sponsors of tonight's program. Fitch Group, a company represented on the Board of Trustees by Wendy Cohn, who's a managing director at Fitch Ratings. And shortly, we're going to hear from the CFO of Fitch Group, Tracy Perini. And our second sponsor is Van Eck, a most valued and long-term supporter of the museum. Thank you to Jan Van Eck, who shares our passion for understanding the importance and lessons of financial history. And of course, Jan is on the panel as well tonight. Our moderator is also another member of the museum's Board of Trustees, Bob Pisani, former CNBC senior markets commentator and highly engaged member of the board, and is the MC at our annual gala. Bob's going to briefly introduce our panel of experts, but you can find their full bios at our website at moaf.org. Now, what else you can find on our website is the incredible array of programming that we run all free of charge. We want no barriers to entry for anyone wanting to learn. We educate the public on the evolution of the financial industry and how financial markets play a critical role in driving all aspects of our economy. And on our website, you can also learn about our highly anticipated opening of a brick and mortar space in Boston. We'll be at Commonwealth Pier, opening next July. To understand more about us, feel free to see me at the cocktail reception, Mindy Ross, or any one of our trustees joining us tonight. You can find in this group Greg Bauer, Matt Perconti, Scott Rettel, and Bob Robati. Now, our topic tonight is timely, as there isn't a day that goes by without an article advocating either for or against the rise of private equity firms and funds promoting the opening of private markets to individual investors that were traditionally reserved for the wealthiest investors and institutions. Now, at the conclusion of the panel discussion, the panelists will address a few audience questions. You each received a card to fill out a question around 6:45 to 7 o'clock or so, depending on how things are going. We will collect those cards, and then Kevin Degnan, the Global Analytical Head of Fitch Ratings, will present the questions to the panelists. And of course, following that brief Q&A, we will have our cocktail reception. So now it is my pleasure to introduce, again, one of our co-sponsors, Terry Perini. She is the Chief Financial Officer of Fitch Group. Tracy joined Fitch in 2022 after a 22-year career at Goldman Sachs, where she held various CFO roles across the organization. Now to Tracy. Thank you.
Thank you, everyone. Good evening. Thank you, David, and the Museum of American Finance for hosting tonight's conversation, and thanks to our fellow co-sponsor, Van Eck. It's a pleasure to join Bob Pisani, Patrick McGowan, my Fitch colleagues, Megan Neenan and Kevin Degnan, and Jan Van Eck at the Hearst Tower. Our topic tonight, unlocking private market investments for retail investors, as David said, couldn't be more timelier. Private markets, it's just the buzzword, that and AI. I think those are the two things that everyone speaks about. But private markets, especially private credit, have grown into a significant source of financing for the real economy. As access expands beyond institutions and the ultra-wealthy, the core questions shift from can retail invest to how do we do this well? That means clarity on merits and risks, thoughtful portfolio construction for less liquid assets, and practical safeguards that work for individual investors. Tonight's panel will explore these dimensions, including product design, diversification and yield, fees and complexity, and evolving regulation to ensure informed decision-making. At Fitch Group, our role is to shine a light on opaque markets so investors, large and small, can make better decisions. As CFO, I see the full breadth of how Fitch contributes across all of our business lines. At Fitch Ratings, our analysts evaluate credit risk across the non-bank financial ecosystem, included private credit managers and structures. Those independent opinions and sector insights help market participants to understand underlying risks, liquidity features, and how stress can transmit through less liquid vehicles. Our other business, Fitch Solutions, goes beyond ratings as investors need comparable data, analytics, and research to navigate private markets. Fitch Solutions delivers market insights, fundamentals, and scenario analysis that support product and design, risk monitoring, and asset allocation. Expanding access only works if investors and advisors have the skills to assess credit risk. Our third business, Fitch Learning, provides advanced trading in credit and related disciplines to individuals and institutions. This commitment aligns with the museum's mission, and we're honored to support initiatives that raise financial literacy across all of our communities. And this alignment goes beyond tonight's event. The museum plays a vital role in educating the public on finance and markets, and we're honored to co-sponsor this program and support their educational efforts, including the Museum Finance Academy Scholarship Program. Bringing high-quality education to new and aspiring investors is essential if retail participation in private markets is to be both broader and safer. So why does this matter now? Because the opportunity is real and in front of us, and so are the responsibilities that all of us hold. Private assets can offer diversification and income, but they also come with complexity, less frequent valuations, and liquidity constraints that must be clearly understood. Our aim at Fitch is to help the market strike the right balance, broadening access while maintaining transparency, comparability, and resilience. Thank you again to the Museum of American Finance for convening this important discussion, and to our fellow panelists for sharing their perspectives, and to all of you for engaging with a topic that will shape capital formation and investor outcomes in the year ahead. I really look forward to this discussion. I am now pleased to introduce Bob Pisani, former CNBC's senior markets correspondent, renowned for his on-the-floor reporting from the New York Stock Exchange and decades of coverage of stocks, ETFs, and market structure. An award-winning journalist and author, he brings clear, informed perspective to how markets work and why they matter. Thank you very much.
Thank you, Tracy. Appreciate that. And thank you for those remarks and for supporting the museum. I spent 35 years as the senior markets correspondent at CNBC, and people always used to ask me, what do you think of the markets? And do they worry you? And the answer was ultimately no, because I believe in the long-term viability of our capitalist system in the stock market. But one thing that did worry me and still does worry me is financial literacy, the ability of people to understand what kind of system we live in, the ability of people to understand what a stock is, what a bond is, what a mortgage is, what the Federal Reserve does, and why it's important to their livelihood. Things that worry me, not the S&P 500 or where it's going to be at the end of the year. I do not worry about that at all. I do worry about the fact that 10% of the households control something like 2/3 of the net wealth of this country. The bottom 90% only control 1/3. That's a matter of expanding the investing culture. We need to do a better job doing that. We need to have more people invested in investing culture, invested in capitalism. And if you don't, then people stop caring and you have a lot of problems. And that's what the Museum of American Finance is about. Yes, it's about explaining history and, of course, Alexander Hamilton, but it's a lot more than that. That history and financial literacy is very much interwoven. And we need to explain to people why capitalism is important, why it matters, and why we have been so successful as a country. Yes, the political system known as democracy matters, but the economic system known as capitalism matters just as much. And what we're talking about today, these kind of topics, are very essential because we're essentially talking about the future of capitalism. So our topic here on the surface of things is private equity and private credit. I'm going to give you one statistic, and Tracy mentioned the tremendous growth of this industry. Bank of America did a study on this a little while ago. Their estimate is the private markets right now are $22 trillion industry. So big, it would be the world's second largest economy if it were treated as a country. Think about that. Private equity, private credit, the private markets, $22 trillion, would be the second largest economy in the world. So here's an interesting question. How did it get that big? And we're going to explore that a little today. We're going to explore a little bit about where it's going, particularly in the retail markets, particularly perhaps will you see it in 401ks? Will you see it in ETFs? How do you get it from the secondary market? How do you expand it outward? And what are the risks? We've got a great panel today. Megan Needham is head of North American non-banking financial institutions at Fitch Ratings. You can see more about her in the program. Patrick McGowan here on my left is the head of alternative investments and manager research at Sanctuary Wealth. And Jan van Eck, a dear old friend of mine, Chief Executive Officer of Van Eck. I'm particularly happy that Jan is here. I first met Jan 20 years ago, I think it was, and Van Eck was a famous firm that was primarily in the commodities market. And under Jan's leadership, Van Eck dramatically expanded first into the ETF space and became the leader in the commodity ETF space, and then became a leader in the crypto space as well, and is generally what I consider to be that rare group of people, a thought leader in general. And he's a man I went to for many, many years for his opinions, and put him on TV for many times because he knows what he's talking about, and he's a leader in this particular space. So thank you, Jan, for being here. Megan, maybe we can start with you here. I guess the question is, how did this market get so big? You know, I like to tell people, well, you know, sort of we had a failure of the public markets in a way. I covered the IPO markets for 30 years. And when I got to CNBC, when I covered it in the mid-90s, there were 8,000 publicly traded companies. And I think, what, Jan, there's 8,000, 4,000 today. It's half what it used to be. And credit's the same way. The market blew up during the financial crisis. There were restrictions put on the banks. They withdrew from middle lending banking, and private credit stepped in. That's kind of my narrative, but give me your thoughts and sort of explain to the audience, how did this thing get so big?
Yeah, I think that's a good point, and I think you're on the right track there. I mean, we cover the alternative investment managers, so the big guys, Blackstone, KKR, Apollos of the world, and we started rating them around 2009, 2010, just coming out of the GFC, and so that was the initial catalyst for sure. So if we look at their assets under management at the time, I mean, it was a fraction. No one would have thought $1 trillion AUM at some point for these alt managers, and most of them certainly are, or some of them are usurping that already, and certainly most have plans to get beyond that. So definitely regulation on the banks was the initial catalyst, I think, for sure, and we saw some more creation and certainly growth across private equity, real estate, infrastructure, energy, and private credit is a bit more recent, but certainly had the early kind of seeds of that planted coming out of the GFC. You had low rate environment for a period of time, and so people were looking for yield, and so that certainly drove a lot more money into the private credit space, and alt managers in particular kind of capitalized that. And you've seen a lot of market disruptions over time. So you've had bank failures in 2023, lots of dislocation, and I think you've seen the broadly syndicated market open and close numerous times in the last decade. And so I think private credit in particular has proven itself to be more durable. And you have a lot of money in retail products and other products that are just kind of continuing to flow into these products. So there's a lot of dry powder sitting around, and they don't have to worry about syndicating externally to investors. They're investing on behalf of their own LPs, and so they have a lot more flexibility. And so I think you now see partnerships with the bank instead of competing head on with the banks. And I think the banks have ceded certain things to the alt managers because they have their own capital efficiency to think about. So this is, in some ways, it's still, I think, early days. There's a lot more total addressable market that they're looking to go after, and I think growth is just going to continue in that space.
Patrick, you're sort of representing the buy side here. Yeah. As an RIA. Does this narrative sort of fit with your understanding? How else do you want us to understand how we got here?
I'm sort of nodding along with everything there, but there's so much you just said because they're going so many different directions, and it's all true. I guess the end note is that I believe it is really early. What I would add is essentially the way that as you mentioned, these companies, whether on equity through IPO, and you mentioned the number of publicly traded companies. I actually read an article recently. There's more ETFs now than there actually are publicly named stocks. So, I think there's a lot of passive investing. There's a lot of ETFs out there that are sort of robo-buying the public markets. And if you remember, the banks are sort of movers of products. They get phone calls to syndicate a bond and create a bond. The investment banks do that with a variety of people. They syndicate it and they move it off their balance sheet to somebody else. And these private credit managers create the loans and they hold them. And so, I think for a long time, they were having really good returns. The index for example, the CDLI index, which is the direct lending index, going back for a long period of time, has basically shown one of the best returns you could have on a risk-adjusted basis, with defaults included, of approximately 9%, per annum over a year, which is a great return. I think in the stock market, we try to bogey it around 7 or 8%. So 9% just in a fixed income, which is more conservative, or I shouldn't say fixed income, but on a credit security is more interesting. I will say that why companies are deciding to not utilize tap the public markets as well is, for a while it was regulatory reasons where banks just simply said, I'm sorry, like, you're too small. If you're not if you're not Ford Motor Company or whatever, we're not going to work with you. But now the companies are actually choosing to not go to the public markets. And I think it's interesting. They're willing to pay a little bit more money to, arguably, to have certainty of execution. If the bond markets do close, they know that a manager has captive capital that they can go and deploy it and execute when they need to. And on the private markets, on the equity side, it's interesting. We are all now, I think it was said in the comments, in the opening comments, around AI and private markets. Sort of in the middle there is actually like AI companies that are private that just don't want to go public. They may want to, but they may not need to. We're seeing that in space. We're seeing these huge technologies, and they're just like, I have plenty of funding, and I don't want to be scrutinized. I'm doing transformative things in the private markets, and I don't want the scrutiny of the public markets. So, unless they need to, there's almost no incentive to go public these days.
Jan, I don't know if you have anything to add here, but they don't want the scrutiny of the public markets. That's true and depressing, frankly, that happens. Part of me says I understand it because the lawyers run everything now. Compliance runs everything. On the other hand, what the hell are you hiding from here? Because that's what a viewer would call and say, why don't they want the scrutiny of the public markets? So you want to add anything here about how this industry got so big?
Yeah, let me start on the credit side if I could, and maybe get back to that, and I'll take it to an extreme. Financial history in the United States since Alexander Hamilton has all been about banks, and then these periodic blow-ups and in financial crises, which have really been the same thing over and over again, because the bank is an unfragile institution, right? You have sort of the ATMs, I'll call it, and then the banks take that money and they go and invest it in a whole range of illiquid investments to try to earn a spread. But if everyone went to the ATM on any given day, no bank can meet that liquidity call. So in a way, so I call it, maybe we're seeing the end of banks. On the private credit side, it's way healthier systemically to have a private credit fund where people can't get all their money back right away from an illiquid investment, but rather have to raise their hand and say, I want my money back in a couple of years or a couple of quarters. That's way safer. On the payment side, and I'm not going to go too far off piste here, but you had, I think, the third most important piece of bank regulation happen this year, which is the Genius or the stablecoin bill, which basically says you don't need to be a bank to be involved in payments. You can be a tech company. And so I think you're going to see an unbelievable change in the structure of the payment system in the United States and the, frankly, decreasing importance of banks. So it's sort of, I just wanted to kind of flesh that out in a broader sense. So it's the reason private credit is growing, as Megan said, but I think there's other aspects which will be extreme. Just to put my final Jan Van Eck comment on it, where is the credit risk in the system? I think it's from Washington, D.C. The whole U.S. history, it's been New York blows up and Washington, D.C. lends the money. Sometimes it takes them a while to get organized, like the global financial crisis. Sometimes it comes fast. But the big debt is coming out of Washington, D.C. and developed markets, so it could be a different type of crisis going forward. Anyway, to your question about the equity markets, and we're an ETF company, so I love public equity markets, but you can really see there's a lot of good competitive reasons why people want to be private. Think about Amazon building AWS, which arguably today carries a lot more value than them just distributing goods online. AWS is their big cloud business. They built that and they were not making money, right? They were plowing all their profits into that business, and they didn't really talk about it a whole lot in their public statements. And they would love that, right? Because they were building this business with tremendous momentum. And that's what you want to do as a competitive firm, is build momentum in early markets and grab as much market share as it's cheap without telling all your competitors.
But they're public.
So it's not the investment.
What's the point there?
Well, my point there is they were hiding it as a public company within another company. But I'm saying you could easily have a startup that was just doing that doesn't want to show their financials.
Yeah. But Amazon was public. They
were public, but I'm giving you the example because we all know about it.
Well, let's just talk about different vehicles here for private equity and private credit to get to the public. So, and all three of you just chime in anytime you want here. Don't wait for me to call on you. But maybe, Megan, we had the White House has issued an executive order that it seems to be encouraging a path towards putting private equity in 401ks. They've had a directive to the Department of Labor, which sounds like figure out a way to get this done. Can you sort of update us on where we are with that? And we can discuss the pros and cons of that, but that seems to be a pretty important move.
Yeah,
that's
definitely.
happened.
And you see the alt managers talking about it a lot. And I think Tony James, who was the president of Blackstone, wrote a book on it years ago, kind of pushing for this. So it's kind of coming to fruition. I think it's very early days because there's still some things that need to be sorted out in terms of legality and making sure you're not getting sued for some of this. I think some of it's already happened, though, with target date funds. So you have alternative sleeves within target date funds, which are offered in 401ks. So you already have a little bit of private assets potentially, but it's limited. But you've seen some of the alt managers partner with traditional investment managers to kind of have that access already. And now I think what they're talking about is now you're playing the long game. And so I think they need to see how things develop from a legal perspective before they kind of jump in. But I think some of them are certainly already moving the puzzle pieces around and getting the right partnerships in place to see how they can execute on that. But these big alt managers have liquid and illiquid strategies across a variety of different collateral types. Secondaries has blown up in terms of, just the investment opportunity there, and that's relatively liquid for a private asset. So I think there's a lot of different pockets that they can pull from to kind of ease their way into the 401k market. But I would say this is not a near-term thing. This is a long-term strategy.
Right. So this gets into this whole education problem. I mean, how do you put this in a 401k where somebody expects liquidity? This goes to this education problem. Can you put an illiquid asset in a 401k? Can you explain this to people? First of all, do you want to? Will people even still be able to understand this? We had, Jan, remember leverage and inverse ETFs? We beat people against the wall saying you got to understand the daily reset and the leverage, and people still didn't get it, and they still don't get it. There's a huge education problem
just to that point, some education problems are unsolvable. People don't read prospectuses, right? And so almost much less so me, but the other people here are gatekeepers, and we really have a lot of power and have to use that responsibly. So Van Eck, as an ETF issuer, never did leveraged and inverse ETFs because we said no one will ever understand them. They just won't get how badly off they will perform from what the name of the fund says. So we're just not going to get involved. On the retirement and 401k asset side, again, individual investors aren't really learning themselves because now that market has gone to the default option, which are these target date funds, and it's really, again, gatekeepers, to my point, making these decisions about the amount of allocation and manager selection and all that kind of stuff.
So let me just move on here. I want to still stay on the White House comment, but private equity and private credit and ETFs, they're trying to get that in now. We saw PRIV, that's one out there. It's really tough, though. How do you do that?
Don't do it.
Don't do it. You heard from, here's an ETF thought leader who says don't do it.
Don't do it. Don't try to mix the two, right? If you're totally liquid, that's an ETF form.
Well, let me take the other side of that. I'm surprised I'm doing this because normally I would agree with Jan on everything. But they said this about bank loans years ago, right? Remember the ETF haters came in and said, okay, you guys, yeah, sure, you got the S&P 500 fund and you got liquid stocks there, but wait till you get an illiquid investment. Okay, try doing bank loans. When the shit hits the wall, there's going to be a lot of people trying to get out of that fund, and you're not going to be able to sell the underlyings. And BKLN was the big bank loan thing, and the thing turned out to actually perform very well It was quite startling. And we've seen this with Chinese equities. We've seen this with some bond funds that are illiquid. Actually, the ETF tail wagged the dog. It was quite surprising. It was like almost like a little magic. Like the markets in China are closed, and yet Chinese ETFs are pricing the underlying equities. They're telling the Chinese what to do. It's a little bit of magic in a way when the market tries to figure it out. I'm not trying to say that you're wrong, because I am extremely concerned about doing this. But maybe that would help create better liquidity of these underlying things to have more ETF trading in that. Do you see what I'm saying?
They can both be right. ETFs
can we both be right?
Well, both statements can be right. Whereas ETFs can bring liquidity to markets and generally do. And often an ETF, like I use the example of gold miners because that's one of our biggest ETFs. The ETF is way more liquid than any of the underlying equities. You could trade hundreds of millions of dollars a day in an ETF, often, probably even with bank loans, where you could never do that efficiently in the direct market. So there's no doubt that ETFs bring liquidity, and often to fixed income markets that are much less liquid. And that's been a big trend in the industry. But there still are those asset classes, and I agree, bank loans, it's worked, but some, it just won't work. So, and it may work for a while, but then one day it won't work.
Well, right, and we're all going to blow up, right? Yeah. You probably don't get involved in this, but there's one Jan and I knew about, Volmageddon. Remember when, was that 2018, when there was a big blow up around volatility funds. So the market there was very low volatility in the markets. What we call the VIX, which is a measure of volatility, was unusually low. So everyone was short volatility, and all of a sudden the VIX doubled in like a day. I think it went to 40 or something like that. It went from 20 to 40, which never happens. It was like a Six Sigma event, and of course that never happens, right? Well, guess what? It happened, and these funds blew up.
Oil futures have gone negative. What could that be?
Yeah, exactly.
Weird things happen.
2020, they did go negative. Yeah, so this kind of stuff happens, and the question to me becomes: is there any systemic risk here that happens in these kinds of Six Sigma events, where it gets to be a real major issue? That worries me a little bit. I don't want to get too far on the rabbit hole. Patrick, just follow up. I want to stay on the 401k thing. Yeah. So, what's the promises and the perils of doing that? What are the issues? We can talk about the problems here, the opacity, the high fees, all the issues around this whole thing. But can this go into a 401k?
I think the short answer is yes. But just to sort of take a step back, I think when you look at the people that are proponents, and like for example at our firm, we're roughly $60 billion RIA. And without the 401k market, we manage wealth for individuals and institutions. And if it's outside all the, so we make recommendations, we show them strategies, include private markets, but we can talk to them about everything except for their 401k, which can be either a large or a small amount for some people's net worth. So the question, obviously, if you're a manager or a sponsor, you're like, okay, well, that's a big pool of money no one's tapped. If I can get in there, that's great. But also, fundamentally, historically, there have been better returns in the private markets. I think one of the things we're talking about here that's a little bit product geeky is like valuations is one of the biggest reasons why we have an issue trying to figure out how it fits inside of a 401k, because the valuations and liquidity sort of are inherent. When one trades on an exchange and you know what the value is every minute, every day, every second of every day, then you can transact. But when you are relying on the net asset value or what a third party thinks the value of something is that liquidity there to sell it back to you or to give you cash in return for that value at that time? So right now the managers are saying that they are willing to give you certain, like usually 5% per quarter of your money back at the value. So if you have questions around the value, well, it's really on the manager. If you think the retail market's getting fleeced, well, the manager is the one that has to give you the money back at that price. So it's sort of like a double-edged sword. I think for a long time, institutional investors benefited, but they cut this deal with institutions, and the manager is saying, okay, I'm gonna commit to you for 10 years, X amount of dollars. I'll send you money. You send me it back at some point, and when you send it back to me, then I'll send it back to you in the next vintage fund, and then we'll just keep going back and forth with this game. But in reality, now they're not sending the money back. There's not that much liquidity. And so you're seeing even institutional investors I think right now we're having the biggest issues in private markets, more so in the retail market, because they're in these locked up funds. They're not getting money back. So they're going to the secondary market, and you're seeing endowments that are getting hit by a variety of fronts, but one of it is potentially being taxed, and they have to start selling stuff on the secondary market. So they're actually, right now, I think everyone's worried about retail. Institutions are no one's particularly worried about, but endowments are definitely selling things at discounts to liquidate this stuff. And so the question becomes, when you move it into the 401k market, secondary managers can go ahead and buy those at discounts. What I was getting at before that was the proliferation of the new products, which was the first question that you brought up. Yeah. So we've gone from the ETFs and mutual funds to interval funds, non-traded BDCs, non-traded REITs, tender offer funds. These are all evergreen semi-liquid funds that inside of them hold illiquid assets. So mutual funds cannot hold illiquid assets. They can go up to 15%, but it's too close to 15 to do it, so no one does it. And then, so there's limitations. These other funds open that up. And so, I think it's a benefit if somebody can take that money and model in a huge 401k plan, how many of my participants sell their 401k per year, and they do it based on age, and obviously ones that are in target date funds 2050 or 2060 have a very, very probably almost a 0% chance of liquidating their 401k. Well, why can't they have a decent amount of illiquid assets? Because to your point, before, if you need liquidity, then you probably shouldn't be in that target date area, but the ones that are closer to retirement should probably have none.
Well, that makes some sense. If I'm 35 years old, I can put it in a target date fund 40 years from now. It still doesn't answer the fundamental question, what happens if they have an event and want to get out? And no matter what education you tell them, no matter what fine line
that is the hardest
you
problem.
put in there, that's still an issue. This is the problem I have with the whole thing. Liquidity, opacity, fees is another thing we should go into, but
sure.
It's a tough thing to explain. So in theory, what disturbs me is what the hell happened to the public markets and how and when you mentioned the great financial crisis and how they kind of, not only, they didn't abdicate, they got crushed. And then the government crushed them again with excessive regulation. Yeah. So this is very depressing to me. Like, this is capitalism at its finest. Private equity, private credit stepped into the gap, the vacuum of the public markets withdrawing and being overly regulated. So in a sense, we're watching the success of capitalism here because private equity and private credit stepped in. Yeah. The country needs credit. Small businesses need money, and they can't get it from the banks. So what do? Well, you pay a little more and you go to private credit. Yeah, and so it works. This is the beauty of it. But I'm concerned about whether the public really understands what goes on here.
I think the 401k market is interesting, and I'm sure Jan has plenty of experience with this. It's evolved over time, and the plan sponsors have gone from being, they basically determine what, if we all have 401ks here, they determine what funds are in the lineup of your 401k that you can go and pick. And over time, I don't know how far back you want to go, there has been a selection process in order to figure out what funds are going to be on your plan, that the number one determinant has probably been fees. So while Van Eck may have great strategies, if they are, and they might be the more expensive, then they're going to be excluded from a 401k plan just because they have a slightly higher, even if it's 5 basis points more than what the cheapest ETF version of it is. So what's driven down the average cost of these 401k funds, which is great, but it's also basically eliminated any interesting strategies. So I think it's come to a point where the Empower came out and wrote a letter, which is the second largest 401k plan provider in the country, and just said, we want private markets. We know they're more expensive because of the amount of cost that goes into syndicating, originating, investing in these things. We also are, point number 2, we think just going for the lowest fee across all options, generally speaking, has just been something that's been a relatively poor idea, but all the plan sponsors are worried about being sued for excessive fees. So the active managers have been worried about it for a long time, and they just gave up and said, fine, let the 401k plans go to the cheapest option, and we have to invest. We're good at what we do, but we're not going to play that game. And some have cut their fees a lot. But now it's almost coming back full circle where they're like, we want the best possible investments in these plans.
So I want to move on and just sort of talk about the difference between selling, the problem I have here is there's a big difference between selling to an accredited investor who you clearly understand the lockup, you clearly understand the high fees, you clearly understand the opacity, and selling to the general public. So Patrick and I have something in common, that we're sort of with the buy side for all these years. I talked to the viewers of CNBC, which were mostly older people who were self-directed, high net worth individuals. And these people were very eager to understand this, but also very suspicious. A lot of them got very burned in the public markets on the IPO business, which I covered for 30 years on the floor. And an email from a typical viewer would look like this. Hey, Bob, thank you very much for backslapping with the CEO of XYZ company that went public 3 months ago. Nice to see you on the floor. The guy got rich. It was nice. I bought on the same day, Bob, because, well, you guys were talking it all up. And now 3 months later, I'm underwater. Could you be a little more critical next time about explaining these businesses to us? And what he was saying there is that there is often a mismatch between the public valuation and the private valuation, which is a problem. And when you're on the receiving end of that from viewers, you get very sensitive to it. And that's the concern that I have. I have a big concern about the fact that you can't value this stuff very easily. I have a concern about the fees. I have a concern about the opacity, and I understand why it exists, and I laud the success of it, but I'm not sure how successful we can make this transition. Plus, if we get any kind of economic slowdown here, private credit is going to have a problem, because there's, the high yield market's holding up very well right now, but all we need is, this stuff is so interlocking now, all we need is one little crisis here, and confidence is going to go away very quickly. So there's a lot of opportunity here, but what I'm saying is there's also a lot of risk. I'm trying to figure out a way I can get comfortable going on TV again. I'm not on the air anymore, by the way, but and actually saying to the viewers, I feel comfortable, like I did with ETFs. You know, Jan knows this. I had Jan on, we were regulars on the air for years because I bought into the ETF business in the 1990s. I bought into to not only equities, but commodity ETFs and bond ETFs, that this was the best thing for the viewer. I personally believed that. And I want to believe in this idea because it's been successful, but I'm worried about the ability to get it to the public. And I'm worried about, are we at the part, and I'm talking representing the viewers, are we at the start of a great adventure where the viewers, retail public is going to buy this, or are we at the tail end where the average retail investor is the poor slob that buys the stuff at the end of the cycle? And you know how that ends. So you see where the position I'm coming from. I want to find, this is capitalism working, and I want to find a way to get this industry bigger. I also want to find a way to get the public markets bigger, but I don't want to get that 100,000 emails from the viewers saying, hey, Bob, thank you for recommending private credit at the top of the market, and we bought all this stuff, and we've gotten burned badly. So it's how do you explain this? How do we make people comfortable? How do we make them understand the risks? How do we keep our reputations intact? You know, Jan and I, we could go on the air and tell people confidently, you should have a large part of your equity portfolio in an S&P 500 index fund. There's no reputational risk for him and I to say that. If the market drops 20%, there's a market risk. We all know that. Nobody's going to scream at him or me. But if we start telling people, buy into private credit, put 50% of your portfolio in private credit, or 50% in Bitcoin, people are going to start screaming, no matter what you tell them, if the thing goes to hell really, really fast. So I'm rambling a little bit, but I'm trying to get you to get to the spot where you make people comfortable with this.
I think the big managers, the Blackstones of the world, Apollos, they're very focused on reputation, and so they understand what is at stake here. I think they're spending a lot of time, and you could probably talk to this more, educating RIAs. They're out there talking to RIAs all the time. And look, retail investors have been able to buy public BDCs for 2 decades. So that's been out there for a long time. 70% of BDC stock is kind of owned by retail investors. So they're not new to certain products, certainly in the space.
Are they all accredited though, or are they?
No, they don't have to be.
accredited.
You can buy it on your interactive brokerage account. Yeah, so that's definitely been out there, and I think there has to be education. Diversification is key in a lot of these investment portfolios. But you're also seeing, you know, Blue Owl sponsor tennis players at the U.S. Open, right? So they are trying to get out to retail investors even more. And so I think they're even more focused on making sure that they don't mess this up, because they want access to the 401ks. And that's the only way that they're going to get it, is to build trust, deliver returns, make sure they're making good on what they say. And
Jan, you have been a master at selling to the public. This guy has been extraordinarily successful in the ETF space. Well, you've done really well, and you know how to. You've hit the zeitgeist. You hit the zeitgeist on commodities in the 2000s. You hit it on crypto. Van Eck has been a very successful firm. So how do you view this as,
Well, I'm a product guy, right? So maybe we can break this. We talk about private markets in the headline of this. Maybe we can break it up into 3 areas: venture capital, private credit, and private equity. Venture capital cannot go into your 401k because you're only investing $1 million into a startup, or maybe $10 million. So if you're really doing venture, then that's not for the masses anyway. So let's just take that out. That's not going to be in your 401k. So then you're looking at private credit, and we've been spending a lot of time on that tonight. I think that's a legit story, right? The banks got out of a huge space, and there's a huge demand for credit to private companies in America. And there might be shakeouts, but that is a structural, regulatory-driven shift. And it's structurally better because there are liquid assets being put in an illiquid wrapper. So that's like structurally, I think, okay. Private equity, right, investing in larger private companies is something where I think that's, I would say, a little bit more controversial, at least in my own mind, right? The only reason to invest in an illiquid investment is one word that we haven't mentioned enough, which is return. There has to be a superior return to locking up your money. That David Swenson used to say that. He was in charge of the Yale Endowment. So what is the premium over the public equity markets? And I don't have a number in my mind. I don't have an answer to this question. But there has to be some kind of premium for private equity. And that's what I'm a little bit less convinced in, because at some point, they can't necessarily deploy all these billions and hundreds of billions of dollars and necessarily get returns that are beating the public equity market.
That's the problem I had with the hedge fund community. To talk about an older alt community, they always
100%.
came in and said, "Oh, we sort of know more than you do." It's big, like, oh, don't look at this hand, look at this hand. And that's why we're charging 2 and 20, 2%, 20%, outrageous amounts of money. Well, because we know more than people. We have a system. And it turns out that in a very, very few circumstances, it's not true, not in equity, because there is no informational advantage that most of those people have. Now, there were very small situations, James Simons at Renaissance, where people actually did have informational advantages. Simons had an enormously cleaned up database that Renaissance got hugely rich on, and he really did. But it doesn't happen very often. The market is very efficient, and it's extremely difficult, which is why I've been at war for decades with the hedge fund community, which has grown to, $3 trillion, on this back of this illusion that we know more than they do, and how they have convinced pension funds somehow to put 30% of their assets into alt investments is astonishing to me, because I don't see the outperformance. You're talking about outperformance, not in the equity space. In the credit space, you might. There are, now I'm talking about equities, okay? When you start getting into other things like real estate, BlackRock might actually have some advantage when it's putting together a real estate fund, when they're directly working with the people who are in the project. There might be an informational advantage. There it might be worth paying up for. But you see what I'm saying here? You brought up the performance question. I've had a problem with the alt community in equities for decades about this. I just don't think it's true.
Yeah. Just to chime in on that, I think you painted this picture, which I think is fair, unfortunately. Now, what's happened, because companies don't want to go public early enough, you see these companies go from pre-seed to Series, Z, staying private, and then finally IPOing, and then the stock drops. And what used to happen is companies would IPO at a $300 million market cap.
And they'd be really young.
And they'd be young. And
they'd be volatile.
You probably interviewed, Bezos. When
I lived through the 90s.
Yeah, right.
So
that doesn't happen anymore. So now you have to say, how do you get access to those stocks and those companies like you used to cover? And they don't exist. You have to go to the private markets. So the way to do it is to be able to get broad diversification. You could do some venture, you could do some growth equity, and basically those terms are just like, companies with pre-revenue, revenue, as they grow, and then as they get into buyout, they're getting into basically companies that could have gone public a very long time ago, and they just haven't. The fact that we have these huge companies, these market caps today, OpenAI at a $400 billion market cap, and they haven't even, they could go public. I think to your point, the informational edge, not legal for hedge funds, totally legal in private markets.
Yeah.
So like these private market managers can absolutely use an informational advantage. The other thing I'll say is, going back to the public-private markets, just like you think about your market cap weighting exposure, there's a dwindling of stocks. I think that will continue. There's a dwindling of market share that in fixed income that will continue. If you owned Twitter, which we probably did and didn't know it in an ETF that you owned, or you owned EA Sports, and you fell asleep and you woke up the next morning and the news came on and said, taken private. And now, the critics and the headlines in the media will say, private equity is terrible, this is like the worst thing ever. It's the same company that you owned the night before. Now it's private, now you hate it. When a private equity firm actually has a transformational plan where they're going to take EA, they're going to do some M&A, they have a plan to grow it. I don't think that's the worst thing in the world, and they have this informational advantage that no one else can tap into. So I honestly think the retail market is totally missing out on this opportunity. And the fact that there are retail vehicles available to access it to them is great. But what you are skeptical on, and which I agree, is you have to do diligence, or a financial advisor has to do due diligence on how these funds sit relative to the institutional funds that they also manage, sitting side by side, and are they exactly the same or are they different? Are you getting like a different style? Are you getting a watered down version? So you have to, there's a lot of
And the issue also, Patrick, is they may be able to do magic, but they can't do it with infinite amount of money.
Correct.
So, what is the limit? What's the capacity that they can do and get these returns? And what are the incentives? I mean, do you ask them, do you have capacity limits on this strategy when you interview managers?
Yeah, I mean, I think, and I inherently, it's a leading question because I think I have my own thesis, like early stage investing does not have capacity limits. The multiples don't work out so well. I think, yeah, you do ask about capacity. I think, at the upper end, unfortunately, what you're seeing is so much money. What's great about private markets is this other thing, which is as the bigger get big, and they say the private credit opportunity was $1 trillion, now it's $40 trillion, and now it could be anything really. Anything could be taken private. What that means is those managers have to deploy capital. So if you can invest with managers before, in the rounds before, there's this downstream effect where if I can, buy a company that's mid-sized, and I know if it's okay, sort of successful, it'll get merged and get bought by a bigger fund down the road. That's like this downstream effect, which is almost, it's a very good indicator when you're going to make money. What doesn't work so well is when the money stops at the top, then everyone down the chain don't make any, and there's more transactions that happen to venture capital in 2022. So like all that money at the top is actually great if you want to go like mid-cap, small cap.
So we only have a few minutes left, but I want to see if we can get some questions in. But also, let me just ask about where we go from here. What's sort of the next steps? So the naysayers, the doomsayers out there say, okay, you guys think that private equity and private credit exists in some vacuum out there, independent. We're not banks, and so if there's a problem with the banking system, we're independent. But history indicates that's not the case, right? This is all interdependent. The banking system, the pension funds, the insurance companies, private equity, it's all interlocking. So if something kind of gets really bad in one, it's going to infect everybody. We saw this, of course, with the financial crisis with mortgages. Tranches didn't matter in the financial crisis. So the doomsayers are saying there's so much money out there right now, and there's a lot of potential for stuff for people to get burned. Let's put that aside for a minute. Give us your thoughts on what could happen, say, in the next 2 years. How could this, let's say we don't have some imminent, something breaks and we get a real serious problem with private credit, for example. Let's put that aside. Let's put the doomsayers aside. Let's assume everything is copacetic. Jan, give us a sense of where we might be in the next 2 years. How is this story going to advance?
I would say I have high conviction that private credit will continue to grow. And I have just a minor subthesis that would allow for fluctuations in credit conditions. And I would say look to the BDCs, business development companies, which are effectively pools of private credit. And they trade every day on the stock market. And they are like the canary in the coal mine for credit problems. And so we'll be able to watch this movie, kind of, I would say, as played out.
But so far,
in
the
business
BDCs have
development.
held up very well. And
They have, but in the last several months, they've gone, because of some of the credit concerns, from a 10% premium to a 10% discount.
Yeah.
And that's sort of because of some of the recent defaults. And I think that's fine, and I think it's a buying opportunity, but it's a good thing for investors to look at as this part of the economy continues to boom. So that's kind of my, I think that's one thing that will probably happen.
Megan?
Yeah, just building on that. I mean, I think the important part is just there's differentiation in terms of performance. There's 170, 180 BDCs in particular. We rate 32. They're not all created equal. There's some that are trading at premiums. There's some that are trading at discounts. And people need to be focused on who the underwriter are, what's their access to deal flow, are they good credit managers, and be picky in terms of who they're selecting to invest in.
So that's an interesting stat here. There was 180 BDC. I didn't know that.
so,
And
yeah.
you rate 32?
Yeah.
And what's your criteria for rating them, whether you decide to rate them or not?
We can rate anything, really,
Yeah.
but the question is always, can it get to investment grade or not? If it's not going to get to investment grade, they're really not interested in getting a rating. So the
So
32 we
does that
rate.
mean of the 180, you rate 32, the other ones are not necessarily investment grade, or would not be? You would assume that if they were investment grade, they would get you rated.
Generally speaking, yes.
That's-
But there's
that's
some that are
interesting.
new that are
That's
still
only
working on their
1 in
capital
5.
structures.
That's very interesting.
That'll get to us at some point, I think.
Yeah, but beyond the BDCs, any thoughts on where we're going to be 2 years from now? Will we make progress on 401ks? Will ETFs find some way to get in? I mean, I'm trying to
Yeah.
crystal ball this out 2 years.
Yeah, I mean, I think 401ks will continue to move forward, and I think that'll, I think there's a lot that has to happen there, but I think the managers will continue to kind of get their chess pieces in place so they're ready to go when that happens. I think one of the other things that we're thinking about, though, is insurance exposures. There's alt managers that own insurance companies. There's lots of interconnection there. There's lots of growth in terms of banks extending credit to NBFIs, and that's been growing significantly, and now I think it's 10% of their loan balance now, or to non-bank financial institutions. So that's going to continue to grow. So regulatory scrutiny is going to continue to ramp, I think, in the space.
Patrick?
Yeah, I think these trends are going to continue. The larger managers, particularly the ones that have insurance balance sheets that have traditional and alternative private markets capabilities and other things that go alongside of that, are going to continue to grow. You'll see there's actually more private equity firms than there are McDonald's. It was an interesting stat I saw recently. I think a lot of those managers are going to be, they didn't realize that they actually raised their last fund. They don't know it yet, but they probably did. And what's going to happen is you're going to see the larger managers launch retail-style private markets funds that are more thematic. So it's not just buy a private equity, but it might be a private equity nuclear-focused private markets fund that includes, the top private nuclear stocks or companies, not stocks, or the value, so the same way you have it in the ETF world, large cap, small cap, value, China, dividends, all these different factors. You can do that in the private markets. There's more, there's more companies in the private markets than are public. And so I think they will grow. They will have more access to private companies as they gobble them up, and they will productize them the same way we saw in the ETF space.
We have time for a few questions. Kevin, we've got anything?
Yep, that's me. Are we good here? Can you hear me? First of all, fascinating discussion. All of you, I know everybody in the audience greatly appreciates it. And since I have the mic, I get a plug, which is we are in the headquarters of Fitch's parent, Hearst, which is a private company. And therefore, Fitch is private. Now, our major competitors, Standard & Poor's and Moody's, are public companies. And Fitch Ratings has always felt that we have an advantage over S&P and Moody's because we don't have the quarterly public revenue demands that S&P and Moody's might have, which could potentially influence their credit decision-making. We can afford to say no to things because it doesn't show up in the market 3 months later that Fitch's revenues dropped. So being public or private, there's advantages and disadvantages to both. We're not private equity owned, which is can be a different level. So lots of questions on the subjects that you all touched. One, though, that was a little different, which I thought was quite interesting, and so I'll throw it out to you. So the public shares of alternative asset manager companies across private equity and credit have outperformed the average funds that they run. Why not just own the equities, equity of the big alternative investment managers?
Yeah, I'm happy to make an observation just in case, and you guys can touch on. But when you own the shares of a company, you are participating in the fees and revenue, fee-paying AUM that the manager has. So there is a strategy in the private markets called GP staking. So you take a minority stake in a private markets manager, and you do get some underlying exposure to their funds vis-a-vis how their fund does means they generate more revenue because they earn a carry, and then they also, the bigger their funds get, the more revenue they make. And that's why these stocks are trading, because they are simply generating higher AUM vis-a-vis higher fundraising and better performance, and then they generate better fees. And the funds they have only have semi-liquidity. So unlike an ETF manager where everyone can pull the money out, and then, the company's gone, these companies have raised all this money, and the amount of capital that can leave is only 5% a quarter at the worst, and on average 1%. So the reality is it's a bet on the profitability of an asset managers, and asset managers have been in fee compression. If you want exposure specifically to a strategy that they run, like you want to own a private company, then you want to buy that fund itself. But to your point, it has been relatively successful, although the stocks have been down recently. But yeah.
Thanks, Patrick.
You want to say anything?
Yeah, I mean, I would just make the observation that is true over the last 10 years or so, but these private managers, and we have an ETF on this, so I'm going to be talking against myself. If you say that a normal asset manager would trade at 10 times earnings in terms of their PE, I'm oversimplifying. 10 years ago, these managers were disliked for a variety of reasons. So they traded at a discount to that 10 times earnings. Now they trade at a premium because everyone loves them. So I don't know if that premium should be there the way it is. So that's the real question in the market. Not that they don't, that they aren't great companies. It's sort of like, what's the valuation and relative to their growth prospects. And so they get punished if they're not perceived as having quite the growth momentum.
And Van Eck does own a business development corporation ETF.
Oh yeah, we have one of those too.
Yeah, what's the symbol?
BIZD.
Yeah, explain what it is though, because it's a very interesting.
It just invests in public business development companies, many of the ones rated by Fitch. So.
Yeah.
And so I'm gonna follow up on a topic. There were a number of questions that came back to the theme that you thought was maybe appreciated or under focused on, which was returns, right? So I'm sure I'm going to butcher it, but John Gray from Blackstone said something along the lines of the best days of private equity returns are over. So as private equity and alternative investment managers cast the net wider for funding down to the retail level, like, do the returns become so diluted by the time it gets to that investor that the advantage versus the increased risk, lack of liquidity, kind of disappears?
Well, I'd love, Patrick, your impression. I don't know if you're asking me.
Yeah,
but
I was asking you because
I think some of these
returns.
managers have expanded their capabilities into different maybe sub-asset classes or different opportunity sets like a Blackstone. And so then you're betting on their ability to kind of pivot out of real estate and into whatever other leveraged loans or like whatever CLOs or whatever other parts of the market, which I think is a plausible thesis, but it's a different value proposition, right? So
I believe the comments John made were that for private credit, that the best returns are behind us. And I think it's less of conflating that the returns are behind us because we're going more to retail. I think the reason that returns are not going to be as good going forward is what you mentioned. Spreads are really tight in the credit markets. They're coming way down, and there's more competition where private credit at the upper end is becoming a lot just like a bank loan. And so spreads are compressing there. So the 11, 13% you were getting 2 years ago when rates were at 5.5, and now we cut rates again today, those yields are floating rates, so they're kind of going to come down. And you probably know the yields of these BDCs, what they'll be before I do, but they'll be 9, maybe 8. The biggest risk there is actually that BDCs start to cut their yields. Then investors want to leave, and then when they leave, then you kind of have this sort of gating issue. But on the private equity side, the issue on the returns there, which John didn't mention on, is that multiples on the private markets are at all-time highs. They're kind of crazy. And so private equity managers, what they used to do is they would buy a company at 4 times. They would borrow money to buy this company. They would, do buy and build and make the company bigger. They would basically roll up a bunch of companies together and sell it at 10 times. Well, multiples are now like at 20 times. So unless you think the companies are going to go to 25 or 30 times multiples, you're not going to get those returns. So the only way to get returns in private equity is actual operational value creation plan or whatever it's called. So I think operational alpha. So that is quite challenging, and the reason private equity had great returns in the past was because of leverage and because that they could just ride the multiple wave and a compression of yields, and that's coming down.
What does operational alpha mean? That means fire people?
No.
I'm just trying to speak
It depends on who you ask. Yeah, well, it literally depends manager by manager. Some are great at that, and others will. I'll give you an example. Like Blackstone bought a fiber company in 2021. They sold it. They made 25% of their money in 2023. I think it was called Hotwire, and it was a fiber company. Like we all get phone calls from Comcast or whoever. Hey, like buy my fiber, and let's go with the cheapest one. Like that's how our due diligence. And it works great. But they said, great. Well, we own the biggest real estate fund in the world, and we'll just introduce them to all of our real estate planned communities. And sales went through the roof, and then they sold it later for 4 times, or 25% increase. So that's value creation plan.
Kevin, anything else?
Yeah, a quick last question, because a couple people asked, including the CEO, how do we rate this stuff? So, Megan, you mentioned it briefly with BDCs about, being selective, but you want to just sort of describe the fact that we have public criteria that gets scrutinized to the education angle?
Yeah, I mean, we have criteria out on everything that we rate, and private credit in particular covers a lot of different things, like across structured finance, fund and asset management criteria, non-bank financial institutions criteria, life insurance criteria. So we have, all of our criteria is as transparent as possible, because we want to be able to explain to investors how we arrived at our different ratings. An A in life insurance should be an A in BDC, should be an A, wherever. So we need to make sure that there's consistency across different criteria, and we talk a lot about that, and there's a lot of scrutiny on that all the time. So, we have building blocks of all of our ratings, and those are publicly available, and we're always happy to talk to anybody about our criteria.
Yeah, I think it fits with the theme of the educate. Here it is. Here's how we rate it. You may not like it. That's fine. But at least you know how we did it. It isn't a black box. Lots more questions, but I know we're at the end of our time, so I encourage everybody to make sure that they grab our panelists and other participants at the cocktail hour, and back over to you.
Thanks. That is a good investment to go to our cocktail party. So I want to thank our moderators again, Fitch Group and Van Eck. Thank you so much for sponsoring tonight.